Good evening, Doc Severson here for the Theo Night Report for Tuesday, May 15th. First off tonight, the market turned into a little bit of a pinball machine. We had kind of a chain reaction based on a lot of different commodities, and a lot of that was set off by the retail sales report this morning. Even though the retail sales came in a little bit soft, what they showed is that the tariffs that were going to be implemented would not necessarily affect sales all that hard. And so what we got is a straight shot up on the 10-year note. So this is really the third rail right now when it comes to the stock market, is higher rates. Now, what I'm amazed by when I look at the 10-year note is how technical this chart is. First of all, in the monthly chart, we have this decade-long downtrend here with lower highs and lower lows. And then finally, what breaks this is a higher high, higher low, higher high combination. So we have a full change in polarity. So this is the first time we've seen that trend line break since about 10 years ago. Okay, so that's at the larger time frame on the monthly chart. So we now have an uptrend on the monthly chart. Within the context of that uptrend, we have had weekly flags. So this is a weekly bull flag to be able to take this exhaustion level and consolidate that, build up a bunch of energy, get it ready for the next run up. And in line with the whole fractal nature of markets, we've even had a daily flag. So as the daily chart has gone into exhaustion, we've even had a daily flag at a smaller time frame. Building up energy, range contraction like this builds into range expansion to the upside. This is actually one of the most technically perfect rallies that I've seen. And imagine that coming from the 10-year note. I mean, these decisions are not being made by somebody looking at a chart. These are being made on fundamental economic conditions affecting interest rates. But it's still amazing to me to look at the chart on multiple time frames and see how this is perfectly working out, how reversals start from the inside out and they propagate up to each additional time frame. Okay, because interest rates are going up, bonds, in this case now this is the 10-year Treasury bond ETF, the TLT, these are breaking down from their flag patterns. So we've been seeing these bear flag patterns. They're breaking lower. So this all makes sense. Now here's where the confusion comes in, because if we look at something like GLD, which is the ETF for gold, a lot of people are thinking to themselves, well, if rates are going to go higher, if we're going to start to get into inflation, then gold as a precious metal becomes more valuable. But that has not been the case lately, as we've seen quite a sell-off in gold and actually a daily downtrend within the context of this big monthly pattern. Actually, this is a huge monthly pattern that's selling up. And this is one of the most bullish patterns that I've seen, but perhaps when something is this obvious, it's going to work out the other way. And this is my concern here, that this is an ascending triangle pattern, which is extremely bullish. This should break out to the upside, but right now, everybody's got this wrong. And one of the reasons why it's going the opposite way is because the dollar is strengthening again. So lately what we're seeing is dollar up, gold down. So that relationship is going to stay in check for quite some time probably. And because of all these gymnastics, we had a lot of movement, as you might imagine, on the equity markets today. So looking at the S&P, let me back up a second and talk about where we are and what we're trying to accomplish here. So in the context of a huge uptrend that we had from 2016 up through the first month of 2018, we've now gone from this range expansion to range contraction. This is what happens to every parabolic rally. We go from a market character condition called quiet and trending into sideways and volatile. Now, I don't mean to keep harping on this, but this is exactly what happens. And we can go back to any example that we want to over the past few years, whether it's 2010, 2011, going into 2015, or even back in 2007. We've seen the same thing happening again and again. Parabolic rallies will eventually exhaust themselves and move from quiet and trending, where everything is very linear, into sideways and volatile with very corrective price action, which is very non-linear, which is to say it's not very predictive whatsoever. It's chaotic. Now we can go down to the next time frame here, the weekly chart. And the weekly chart was also in exhaustion to the upside, and it has done exactly what is required. It's gone from range expansion to the upside to complete and total range contraction. You can see that there's absolutely no trend within this. In fact, this is a triangle pattern which keeps working into the apex of this triangle. And in doing so, it's building up a tremendous amount of energy. Now, I went back over this a few weeks ago, showing that every time the price works itself up into this level of energy, it does not sit there. It starts to trend. So now, of course, the question is, all right, which way is it going to trend? And if so, is it going to break out of this consolidation pattern? One of two things will happen from this sideways and volatile character. Either we're going to get a reversion to the mean. In other words, what happens is the price ends up breaking out of the triangle and the uptrend is assumed once again. Volatility collapses. Everything goes back down to quiet and trending again. And we've seen this happen over the years again and again and again, such as the rally that came out of the consolidation that started in 2016. The actual event that kicked that off was actually Brexit, believe it or not. So Brexit kicked the market out of the corrective pattern and back into a quiet and trending uptrend. Okay? Or the converse of this is going to be a move, a very harsh and sharp move to the downside, which is another code word for saying bear market. So this consolidation can actually migrate into a downtrend like this. So all this energy actually gets flushed to the downside. That is still on the table, especially if we end up printing a lower high up there. Again, what kicks this off is getting everybody too complacent, too bullish, too lax, just assuming that prices are going to go higher. And that's usually where the lower high sets up and they get devastated to the downside. So again, this is where we're sitting right now. Big decision point over the next few months. And it's going to come down to what happens here in the next week or two. The next week or two are going to be key as to which way this chart is going to go pretty much for the remainder of the year. So now let's go down to the daily chart and let's zoom in here and let's determine some decision points, which will let me know which way this is going. Okay, so we can really get it down to this level. Again, technical analysis is not for predicting the future. All it's really for is giving yourself a framework from which you can make effective and objective decisions. Okay, so I've got this zoomed in, and again, I'm using the spiders here. I could use the SPX, I could use the S&P futures. I like using the spiders here because I do track the expected moves on a week-to-week basis so that I can make plays against them using the spiders. And so what we can see is these cyan lines here, these light blue lines represent front week expected move for this Friday. So it's got a few days left to go. We're closing in on that lower expected move. Now, what's been happening lately is that we've seen the price just completely ignore these 1 standard deviation expected move limits and just blow right past them. In fact, we've seen it go out to the back week expected move, which is the orange lines here. So I'm going to use this week's expected move as well as something that I don't use all that often, which is a Fib retracement. This is the one time that I think Fib retracements are warranted in terms of determining a decision box. So I'm going to start this from the very bottom here, run this up to the top of the swing. Certainly that's the top of the swing right now. And what we can see is that we also have a very important pivot right here, which goes right in line with that important pivot level, which is right around 2682 on the full S&Ps. So here we have that confluence point that we're always looking for. We have the price level, which is obviously an important pivot point. That was former resistance, which becomes new support. So 2682, or in this case, 268 on the spiders. That's in confluence with the 38.2% Fib retracement, which is a very important Fib retracement, is also in confluence close to the expected move for the week. So let's map things out in terms of what could happen from here. If we see the price pull down to some level, and it can pull down to any level that's above this 2682, the 38.2 retracement, anything above there, and it still has not changed the polarity. It's still an uptrend. So this is fully okay to retest that breakout level. And this is a very common signal that we see within markets. We see markets break above a level, and then they come down and retest it from above. And then we would expect to see some type of bounce from here. What happens after that is obviously very important. Does it create a new high? Or does it bounce up and print a lower high? That, of course, could be dangerous if it then breaks through 2682. So the bullish outcome is in the yellow here, as if it actually bounces from there, but it has to eventually print a higher high, which is going to be above, in this case, about 274 or 2740 on the full S&Ps. Now, let me walk you through the bearish outcome. The bearish outcome can come through in one of two ways. Either we're going to see the price just undercut 2682. And if it does that, that's going to print by proxy that lower high that we were worried about. And then who knows where we're going to find support at that level. But this is consistent with how we've seen the price working. We've seen a couple of reversal candles and then it just completely dives. Or we've seen reversal candles on the downside and we've seen just strong rallies from there. So if it undercuts the 2682, that's consistent with current behavior. We will once again retest the lows down here, whether it's the 200-day moving average or whether it's something as deep as the February lows, which are closer to that 2500 level on the full S&Ps. The other way that the bearish condition could turn out is if we do get the bounce at 2682 and then roll over, print the lower high. Actually, that, like I said, that's even more bearish, because what that does is that gets too many people on the wrong side of the boat before the boom swings over, knocks them all overboard. Again, a lot of very rapid market movements occur because of the fact that too many people are caught leaning in the wrong direction. So as you can see, what happens here in the near future, just within a very small decision box, is going to be very, very important. And this will kick off how we trade from here. If we end up bouncing off 2682 or some level higher than that and bounce from there and then go into kind of a quiet grind, we're going to go right back into some of the strategies that we played during this period here, because we're going to be essentially be long gamma. We're going to be net buyers of options again. However, if we see the price undercut down here, then I'm going to get into looking at selling options again. We should see a fairly substantial spike in implied volatility that goes along with that. However, we haven't seen much through this period here. In any case, we'll get larger realized volatility, and that's still going to favor the intraday trader. All right, folks, I hope that makes sense. This is why I break things down into different time frames so I can see kind of the inner workings, because reversals always start from the inside out. So if we map what would have to happen to cause a reversal at this point, or reversion to the mean to go back up to an uptrend, then we kind of have things mapped out. We're not predicting the future. We're just telling ourselves what we're going to do based on what the market actually does within that decision box. All right, folks, thanks for listening. That is it for today's report. We'll see you tomorrow.